Our today's topic is an insight into board report and secretarial standards 4. And we have with us today our panelist, Mr. Ramaswamy Kalidas, partner BNP and associate. Welcome, Mr. Kalidas.
Hello.
Thanks for your time.
Thank you.
Thank you. Thank you, sir. We have with us our moderator, Mr. Bala, as usual, ever green, ever enlightening, and always sharing the knowledge. Today, our presenter is Ms. Nayan Handa, partner Mehta and Mehta of Delhi. Welcome, Nayan. Thanks. Nayan, to just introduce you, Ms. Nayan Handa. Nayan Handa is a fellow member of ICSA, and she has experience in corporate law and secretarial and other areas for almost 9 years. She has a 7-year post-qualification and 2-year pre-qualification experience. And she is also involved in various corporate law practice. Welcome, Nayan. Let's, to give you a small introduction of our panelist, Mr. Kalidas. Mr. Ramaswamy Kalidas, it's a short introduction, friend, but it's very long, so you can imagine if it is elaborate, how long it would be. It will take me 10 minutes. So we have made it short. He has many things to achieve, has achieved a lot. Mr. Kalidas is a distinguished professional with a lot of academic background. He is a fellow member of ICSI. He holds MBA Finance from Jadavpur University, Calcutta, and a BCom Honors from St. Xavier's College, Calcutta. He has over 4 decades of industry experience. He started his professional journey in 1978 and was in a various significant position in various leading companies like Ambuja Cement and ACC Limited. He served as a company secretary senior vice president at Reliance Power Limited from October 2010 to June 2017, and later as a company secretary and head of compliance at ACC Limited until his superannuation, and currently he is a practicing partner at prominent firm as mentioned earlier. Further, can you change the slide, please? Further, Mr. Kalidas' contribution extend beyond his professional roles. He has been visiting faculty member at XLRI, Jamshedpur, where he taught corporate law and governance. He is an author and written hundreds of articles on corporate law, SEBI regulation, corporate governance, published in various journals, portals, and regular speaker at seminar conference organized by various professional bodies across India. Further, he is the author of several books on company law and corporate governance, of which includes Law and Practice Relating to Company Meetings, Law and Practice of Directors and Board Management and KMPs, Commentary on Law Relating to Directors and KMP. Further, he has served as a specialist editor for esteemed publications like C.R. Datta on Company Law and M.C. Bhandari's Company Law Procedures. Since 2020, Mr. Kalidas has been a member of the Secretarial Standard Board of ICSI, contributing to the development and standardization of corporate practice. Welcome, Mr. Kalidas. Thanks a lot for your time.
Thank you. Thank you. It's a great pleasure for me to be participating in this webinar, and it's always a pleasure to be articulating on intricate issues with the members of the fraternity. Thank you, Dipti.
Thanks a lot. Friends, we have as usual our panelist, Mr. Bala, who is having experience over the 4 decades. He's also equally well-experienced person, worked with Foseco India, and he's a regular speaker at various forums and contribute various magazines, various articles. And as you know, he is very well known for his articles on recent decided cases. Welcome, Mr. Bala. Friends, Mr. Sudhakar is on a holiday, so nowadays he's not there. Once he's back out from the holidays, complete holiday, he will start joining the webinar. He's in US. Okay. Okay. As regards topic, board's report. From my earlier days of practice, I used to say that board meeting is an engagement ceremony of daughter and AGM is marriage ceremony. The secretarial department is in charge of both these functions so much, board and committee meeting, whatever is. The secretarial department and the CS and all involves so much preparation, so much compilation of data, so much management within timeline, touching each and every department, collating information, presenting, coordinating, investors, stakeholders. It's a Herculean task. And it is becoming more and more complex, complicated, more and more, you can say, informative. And that's why the volume and the quality keep on increasing. And so the responsibility of Secretarial Department. One of the important part of the year, the preparation of board report, a report by the board of directors of the company to all the people, all the stakeholders is very important part. And that is to be taken care by the Secretarial Department. Over the period, the information to be given in, excuse me, sorry, friends, since I'm in a hotel. Okay. So when the board's report, it involves so much information which a secretarial department has to gather, and it cannot be done on the day or in a month when this report has to be prepared. It has to be over the years because it is the compilation of all the information happened during the year in the different department. And further, it's not only gathering information. You have to ensure the information is what should be presented, because what we want to present is compliance, governance, ethics, values. So that should be ensured that in each department, the policy is there, it is implemented, and we have to keep track. So that when finally we have to disclose all that and give our report to all stakeholders and public all over, it comes out in a best way. Because if at that time anything which is found which is not in a good spirit, then the onus and the tension of the department is tremendous. Because then it comes on the secretarial department why it was not mentioned earlier. It is so important. Hence, it becomes very important for secretarial department to make aware each and everyone that what is their importance, their implementation of policy, governance, compliance, ethics, because that will be disclosed to the stakeholder, and which is very crucial for the goodwill, reputation, valuation, and future growth of the company. So in short, we can say each and every department, each and every person of the organization contribute by acting and not acting in a non-compliant, non-governance way, help and build the company and increase the value. And this way they contribute. This knowledge is necessary, that atmosphere is necessary, and Secretarial Department is at the helm of this. So this board report is the ultimate time where we tell what we have done during the year. And it's a very onerous task. And as the time passes, it includes so many information. Like earlier, or now at all, as on today also, DRHP is such a huge document. But I will say, this board report, the volume has happened so big. Now it is like a kind of big document, earlier kind of DRHP. It's not that voluminous, but still for 1 year you are doing that. It's huge task. And to discuss that, how to manage, what you should take care, and how you can prepare in advance, we have no other than very experienced person, Mr. Kalidas, to share with us how you should be prepared with his own experience, knowledge, and being a Secretarial Standard Board member, will share his experience and knowledge, how we should be prepared to our all participants. Welcome, Mr. Kalidas. With this note, I'll request Mr. Kalidas to say a few words on the topic, then Mr. Bala a few words, and then Nayan, you can stop. Over to Mr. Kalidas, please.
Thank you once again, Deepti, for the introduction. And well, I won't take much of the time because there is a presenter who would be articulating on the views relating to the topic. But suffice to say that, the contents in the board's report as of today is a far cry from the very, very anemic document that you used to bring out by way of a board's report under the Companies Act of 1956. Those of you who have learned the 56 Act will recall that Section 217 called for only the disclosure of information relating to the state of affairs of the company. And then, by state of affairs, you are supposed to capture the quintessence of what transpired by way of major events. Then apart from that, you had to talk about the comments or the disqualifications of the auditors, if any. Then the changes in the board's report, the recommendations insofar as the dividend was concerned, and the changes in the auditors, if any, because at that point in time, every auditor was retiring from the anniversary of one AGM to another AGM. And then the transfer to general reserves was a mandatory requirement, unlike in the present act. That apart, there are only two enclosures I can recall, which also came later. In fact, in 1975, you had the first annexation in the form of the Statement of Disclosure of Information relating to employees. And that point of time, the disclosure was required of employees who earned a salary of rupees 3,000 per month or more, or 36,000 rupees per annum. So, prospective grooms felt very, very happy if their names figured in the director's report, because those that were hunting for grooms would consider this as an important qualification. That apart, you had later on the requirement relating to technology absorption and the extent to which the company had contributed to the national exchequer by way of foreign exchange earnings and foreign exchange outgo. That apart, there was very little, so you could kind of hide an elephant from the shareholders. And it was a very pedantic exercise, required very little of expertise. But now we have come a long way, primarily because the requirements under law have been extended manifold in the form of humongous amount of disclosure of information. That apart, for a listed company, apart from what you need to disclose in terms of section 134, you have the requirement of a separate section of the report on corporate governance, where you will talk about ethics, various aspects of governance that you have practiced. And very recently, in fact, since the last 3 years or so, particularly for companies which have the reputation, or which are part of the top 1,000 companies in terms of their market cap, you have a requirement of BRSR, and the requirement is going to be further strenuous next year, because you have to now not only report on BRSR, but there will be also a rating of the BRSR initiatives, which is going to be quite a challenge. And the fountainhead to all these activities revolving around the preparation of the director's report is the company secretary. The company secretary is the prime coordinator where it comes to gathering information. Please, members of the fraternity, do not consider your role to be passive. You are not an accumulator of information. You are actually, you are not even an aggregator of information. I would say you are the linchpin insofar as the coordination efforts leading to the compilation of the report. And you must, work with passion. It's not a very pedantic exercise merely intended to comply with the requirements of law. It's much more than that, and you should really not answer to the call of duty in a very theoretical manner. Never adopt the ticking the box approach where it comes to compilation of the information on the director's report. Be passionately involved, tried to be transparent to the extent possible. In fact, go beyond the requirements of law, because the transparency and disclosure of information in a dispassionate and in an ethical manner is actually the hallmark of corporate governance. So with this few words, let me throw open the topic for discussion. Thank you. If there are any questions that any of the participants have during the course of the discussion, I'll be too happy to field them. Thank you so much.
Thank you, Mr. Kalidas. Mr. Bala, few words and we can shift to man.
Good morning to all of you. It is always a pleasure to be with you every Saturday and have the knowledge sharing section. As we can see today, now it is around 220 people who are there for the session. That shows the importance of this particular topic. Our earlier panelist, Kalidas, has actually outlined the difference between the 1956 Act and 2013 Act. I remember in 2013, the company where I was working, though it was a listed company initially, the balance sheet was running something around 32 pages only, including everything. That is much before corporate governance, management discussion analysis, and other things. That means that clause 49 was introduced. Once the clause 49 was introduced, after this, all this Enron debacle and Arthur Anderson going out, etc., and all this thing, the next year, the balance sheet of ours has ran around 130 pages initially. That was the case. So that shows the enormous amount of the disclosure which has been actually brought in by the regulators, especially after the corporate governance has attained the focus on this. That is one. And second thing is the board report is nothing but, as Dipti mentioned, engagement marriage. I would say it is like a school people, we get the progress report at the end of the year. What has happened? What is the performance of the student? How many days he has attended? What activities? What is the post? What is the thing? It is giving the report actually. We used to get the report. The quarterly exam, half-yearly exam, 3-quarter exam, end of the exam. What is the thing? Other activities. It is exactly similar to that. What all happened during the year in the company, right from the 1st of April to 31st of March. Even after that, the post-event, what has happened till the time of writing the board report, which is of material nature, all these things have to feature in the board report. That means writing the board report cannot be done the overnight or within 1 week before or something like that. It has to be worked throughout the year. As and when the event takes place, the company secretary has got a duty to note down all these events. And before writing the board report, he has to work back about 3-4 months back, depending upon the nature of the company. If it is a listed company, the time will be required more. If it is the other companies, maybe the time will be less. That is the way he has to work with, number one. As Mr. Kalidas has puts it very clearly, company secretary is not the generator of the information. Company secretary is a presenter and compiling the information. So there are so many inter-departments relating to, finance department, marketing department, HR department, other environmental issues department, labor department, many things. Because ultimately today what is called for is all the material events which are required to be disclosed. This is the information which is given. What is material? What is not material? Again, it is a big question. Actually, it comes into the cases. So with that, what happens is it is a greater disclosure information which is coming out on the board report. And both of them, Dipti and Khalida, they are actually the secretarial board. Our institute has been bringing out the secretarial standards on various issues. One such secretarial standard, what is actually mentioned in our webinar also, secretarial standard 4 on board report. Very elaborately, they have brought out the report, what are the various disclosures which are required to be done, item by item, what is to be included, what is not. Very elaborately, they have written, including the listed companies as well. Because although we talk in the master class for the Companies Act, but we cannot out of sight of the LODR regulation required, because listed companies are required a lot more information which are specifically for the listed companies as well. So with this, what happens is one has to work back, one has to actually have the better coordination with all the departments and to bring out the report. The draft report is circulated to the board members initially and is taken the outputs, etc. and other thing and done. Ultimately, the report has to come with the disclosure. And the non-disclosure of anything which involves a lot of penal action from the regulators. Because nowadays, because of the digitalization, when everything is submitted on the online, the regulator periodically take the inspection on the online. When he go through the online, when he actually able to coordinate many issues, he is able to make out what is gone wrong, what is gone right. In which case, you will conduct the inquiry, you will conduct the investigation, you will call for the information, etc. and other thing and that. If there are any non-compliances, ultimately people involved, the first itself is a compliance officer. Nowadays, the regulator has been recognizing company secretaries' responsibility to ensure compliance, not only on the company side, but also other applicable corporate laws. That is the thing. So in such a cases, we are actually having a greater risk in not bringing out a proper report with the disclosure, which are actually recorded in that timely manner. That is the very, very importance of that topic. So with this, I think I'll ask Nain to take us through. She is going to discuss all these aspects. Especially, she is going to talk about the disclosure. She is going to talk about various annexes which are actually required to be done. And of course, she will also touch upon the time limit and other aspects, signing the report, who will sign, when we will sign, what is the time period, etc. And all this. She will give us an insight of this. And as usual, I request the participants to put their questions and clarification in the chat box. I can already see people already started putting the questions in the chat box even before the webinar has actually started. As and when things are there, we will periodically address this with our expert. I think Mr. Kalidas is a very veteran in this field, having more than about 4 decades of experience, and he has worked with the renowned companies, especially the listed companies, and he has seen many things inside, right from 1956 Act to 2013 Act. Today, he is actually in the practicing field. So not only that, he is also a chartered accountant himself. So with this, with varied experience, we will have a better sharing of his knowledge, practically the situation, etc. What is the best thing can be done, how it is to be interpreted, all those things we can have a better view. Thank you very much for Kalidas being with us today. Many thanks. Nain, you can start with the presentation.
We have with us Mr. Akshar Patel, who is also a chartered accountant and company secretary, who is a accountant tax consultant for the Mehta and Mehta. Akshar, would you like to say a few words on the topic, or you will comment it during the presentation only? Akshar? I think we can take it during the presentation. Nan, you can start. Thanks.
Dipti, just 1 second. I would like to clarify to Ms. Balakrishnan that I'm not a chartered accountant. Okay, I'm only a company secretary and an MBA.
I somehow I get a feeling you are a chartered accountant too.
No.
Okay.
His knowledge, he has done financial management, so that's why you have. So his knowledge on that is also very good. That's
okay. I stand correct. I stand corrected. Thank you.
Okay.
Yeah, Nan, start please.
Yeah, thank you, ma'am. Thank you, Bala sir. So today we are going to discuss upon the secretarial standards on the report of the Board of Directors. So the topic will cover this following points, like the board report, a director's report as it was earlier known as, and forms a part of the annual accounts of every company as per the Companies Act. And we're going to cover the Secretarial Standard 4 on the report of the Board of Directors, which prescribes a set of principles for making the disclosures in the report of the Board of Directors of the company and matters they're related thereto. So ICSI in its official release stated that in order to promote the standard practice in preparation of the board report, the ICSI has issued the Secretarial Standard on Report of Board of Directors, that is SS4, which is effective from October 1, 2018 for the voluntary adoption by the companies. So this is also not mandatory yet, but the recommended in nature. So the institute has also brought out a guidance note on the paper of the Board of Directors, which from the even from the ICSI guidelines, we have taken some insights. And the guidance note on the report of the Board of Directors issued by the ICSI sets out the explanations, procedures, and what are the practical aspects in respect of the provisions, which is contained in SS4 to facilitate the compliance thereof by the shareholders. So under the Companies Act 2013, it is mandatory for every company board of directors to prepare a report, and that accompanies the financial statements. And the report is presented to the shareholder during the AGM, that is annual general meeting. So SS4 sets a comprehensive set of principles and guidelines that governs the disclosure made in the board report. So these principles ensure that the report offers a thorough account of the company's performance, financial standing, and the governance practices, and the other significant matters. So the board report is a very vital communication tool between the company's management and its shareholders. It informs the shareholder about the key development, achievements, challenges, and the future prospect. So the report typically includes the summaries of the financial performance, operational highlights, significant event that occurred during the year, compliances with the law and the regulations, corporate governance practices to be followed by the company, and any other pertinent information that shareholders and stakeholders should be aware of. So the primary purpose of SS4 is to standardize the content and the format of the board report. So the standardization enhances the transparency. So it enhances this transparency and accountability and clarity in the corporate disclosures. So by adhering to these standards, companies ensure that their board report not only meets the regulatory requirement, but also effectively communicates the relevant information to the shareholders. So these facilities inform the decision making and promotes trust and confidence amongst these stakeholders. So in essence of the SS4, it plays a very crucial role in guiding the companies in the preparation of their board report, and it ensures that the report fulfills its statutory obligation and serves an effective tool for the shareholder engagement and the corporate governance. So here is section 134, which provides that which shall be included in the report of the Board of Directors and the data to be included in the report. So I'm giving you the brief, like the web address should be there in the annual report, which has been placed, and the number of meetings of the board report, director's responsibility statement, which further includes the annual accounts were prepared, followed by the applicable accounting standards with explanation for any material departure. So directors choose and apply the accounting policies consistently and exercise the prudent and the judgments and estimate, ensuring on the accurate views of the company's financial position and the performance for the year. And it should also include the director should ensure that proper maintenance of adequate accounting records in accordance with the legal requirement to safeguard the company's assets and it prevent from the detect fraud and irregularities. And the director had prepared the annual accounts on an ongoing concern basis. And for the listed companies, the director established and ensured the effective internal financial control that were adequate and operational. So this is the director's responsibility statement, which should include these points. So further, it should contain the details in respect of the frauds reported by the auditors, a statement on the declaration to be given by the independent director, explanation or comments by the board on the every qualification, reservation, or any kind of the diverse remarks, particulars of loan, guarantee, investments, and particulars of contracts or arrangement, related party, the state of the company's affairs, a state on the formation of the risk management policy for the company, and the details about the policy on the corporate social responsibility, which is formed during the year. So here we can see the board report serves a very crucial communication tool from a company's board of directors to its stakeholders. So it delivers the comprehensive information which encompasses both the financial and non-financial aspects. So this includes the company's performance and outlook, notable updates in the management and the capital structure, proposal for the profit distribution, ongoing and future initiatives in expansion, modernization, and diversification. So additionally, it covers the matters such as the allocation of reserves, potential capital increase, and other pertinent updates essential for the stakeholders. So the board report should be based on the company's standalone financial statement and not on the consolidated financial statement, and should relate to the financial year for which such statement is prepared. If any information is mentioned elsewhere in the financial statement, a reference thereof should be given in the board report. So instead of repeating the same. So the Companies Act 2013 maintains the certain disclosures to be made in the board report. And a listed company is also required to comply with the certain additional requirement, which is as mentioned under the security law. So, and Securities and Exchange Board of India, that is SEBI LODR Regulation 2015. So similarly, companies whose securities are listed on an overseas stock exchange, they are required to comply with the additional requirement as may be, which is specified by such stock exchanges. Further, a company which is regulated under any other law, so may also be required to make their additional disclosures in its board report as stated in the respective applicable laws. So applicability of SS.
Can I interject on the presentation so far?
Yes, please.
A few points. One is Nayan talked about the requirements under 134. Let me tell you that the requirements are not optional. The compliances are mandatory because the expression used in section 134 is shall. So shall connotes that there is a mandatory application insofar as the disclosure of the information is concerned. Now, the second thing is that whether the board's report can be placed for approval by the shareholders at an extraordinary general meeting. You know, some people might ask the question whether it can be placed at the extraordinary general meeting. The answer to that is that no, it has to be placed only at an AGM, given the fact that section 102 sets out the items of ordinary business which are to be placed at the AGM. And one of the items is the adoption of the board's report on the year. Third is Nayan spoke about standalone. I'm afraid that if you are a company which is a holding company, the requirement under 129 is to provide to the shareholders not only the standalone results, financial statement, but also the consolidated statement. So in a sense, the board's report should also inform the shareholders on the consolidated basis, apart from the standalone results. And the fourth thing is that, you know, we talked about the accounts being adopted on a going concern basis. What is this concept of going concern? I think needs some articulation, because it is assumed that a company is a juridic person, and therefore, you know, it can be exterminated only through the process of law. So the assumption is that operations of a company are sustainable over a period of time, and hence the concept of going concern. Now, if there is some development which happens in the company which impacts the going concern status, such as the company's products are declared to be illegal, or for that matter, the company is no longer allowed to carry on the activities because of some regulation, or thirdly, the factory or the premises where the operations were carried on have been completely destroyed. Now, these are circumstances which impact the going concern concept, and the auditor, it is his onus to report on the going concern concept and for the board to respond to such. Thank you. Go ahead, please.
As Kalidas puts it very correctly, even the going concept has to be actually verified and confirmed by the statutory auditors. And there is a accounting standard which actually spells out the various criteria on which the going concern basis is to be considered for the accounting purposes. So one of the criteria which actually an auditor generally sees is the company is financially stable and they have enough to meet the obligations to continue the business in the foreseeable future. That is one of the very important things which it is talked about in the accounting standard. That is one thing. And not only that, the director responsibility statement. Also, you have to make a categorical statement on this particular concern. That responsibility comes upon the board of directors. So that means, as Mr. Kalidas puts it, it is not only the responsibility of the auditors to certify it, it is the board itself has to take and question the continuity and stability and going concern, etc., while writing the board report. That is the onus is costed upon the board of directors. Yeah. Yes, Lai, go ahead.
So applicability of SS4 is non-mandatory in nature. So as for the OPCs and the small companies, the board report should be in abridged form as prescribed under section 134(3)(a), which is to be read with Rule 8A of the company's account rules 2014. So SS4 clearly states that in case any particular disclosure is not applicable to the company, then the same need not to be disclosed in the board report, except where it is specifically required to do so. So the Act 2013 is silent in this regard, and this has been a contentious issue for so long. So here we are covering some board report contents, like what are the disclosures to be there as per the SS4. So first disclosure should be the financial summary and the highlights. So the financial highlights, it provide a concise summary of the company's key monetary results, typically presented in a dedicated section of its financial report to the shareholders. So these highlights encompasses the critical financial metrics such as the net cash flow, liquidity positions, dividend payouts, and the deposit figures. So they offer the shareholders a clear snapshot of the company's financial performance and its ability to generate and manage the funds effectively. So the matters to be included in the reports are covered under Rule 8 of the company's Rule 2014 Sub-Rule 5(1) of the said rules provide that the financial summary or highlight shall be disclosed in the report. So the financial summary and its key highlight should be supplemented with the contextual information, which is encompassing the microeconomic factors, geopolitical development, financial trends, industry-specific dynamics, and any other specific details which is influencing the company's operations and market environment. So for a listed company that has listed some specific securities, the board report should include the business highlights, which is aligned with the segment reporting requirement. So in the case of an unlisted company, the financial summary in the board report may be disclosed on the segment by segment basis where it is applicable.
Just 1 minute.
Yeah.
If you can go to the previous slides. Mr. Kalidas, nowadays, you are expected to provide a plethora of information, in the director's report. Even if you see the current annual report of those large company, there are plethora of informations like, industry, where they stand, this and that. And sometimes, this becomes so subjective, whether, auditors, what is that they should comment, because somewhere, the auditor also has to give their opinion whether the company's business is sustainable or not. Now, and tomorrow, if company goes to the drain, how do you crystallize, the liability of the professionals, like chartered accountants, CFOs, in-house CFOs, and probably sometimes even a practicing company secretaries?
Good point, Atul. In fact, as I said in the introductory presentation, we have come a long way in terms of the quantum of disclosure in the board's report. Now, the reason why the board has to now comment on the macroeconomic parameters, and in fact, that is why you have a section in the board's report on MD&A. Now, the reason is basically this, that you see, a company does not ever exist in a vacuum. It has actually impacted very substantially by the ecosystem, and the dynamics of the ecosystem has a great impact on the sustainability or otherwise of a firm. Let us take, for example, the number of industries which have been kind of forced closed because of the impact of technology. Like, for instance, how many of us today read the newspaper as we used to do earlier on? How many subscribe to a physical newspaper? I mean, I think if you take a survey of the number of subscribers to physical newspapers, you will find that very few people are reading newspapers because the information is available as it were in your mobile, and people don't want to read elaborate editorials, etc. So if you are therefore a company which is in the newsprint industry, now you must, the shareholders are concerned at not only at the the financial position of the company, but also the circumstances that impact the company. Like if you are in newsprint, every newspaper that you print leaves an imprint on the ecology, because you are contributing to deforestation by printing newspapers. So therefore, people don't want to publish beyond what is necessary. And in fact, many newspapers are coming out with recycled paper. If you see now, this is basically because you need to leave your comment to the shareholders as to the footprint that you are leaving on the environment. Now, where it comes to the auditors, now the auditors' view is, when they are talking about the going concern concept, whether they are satisfied with the going concern concept at all or not, is not something which can be decided based on the performance of the firm. It should be also considering external external factors such as the one which I explained. So therefore, the auditors have a responsibility to, make a dispassionate and a fair comment on their going concern aspect. Now, if they are found to be wanting, if they are not, like it happened in the case of Enron. Now, why did Enron collapse? If you look at Enron, the auditors were participative in jacking up the accounts, because one of the weaknesses in the American GAAP is that the American GAAP recognizes even the capitalization of goodwill. And goodwill is supposed to be amortized, unlike in India. As per I do not know what is the position in the US law today, but at that point in time, goodwill could be amortized over a period of 50 years, 50. So therefore, the huge impact that the recognition of goodwill brought in Enron's balance sheet was such that the shareholders were taken in by the enormity of the quantum of goodwill. So that is where Arthur Andersen they were cohorts in jacking up the numbers, and they had to necessarily own up responsibility. So the auditors should be extremely conscious of their views where it comes to sharing their perspective on the going concern aspect, right?
Mr. Kalidas, let us understand which is already a practical situation we had in the past, where some research company comes out with a report, and the share price of those group just start falling in. Now, if I'm a statutory auditors of that company, because the whole ecosystem starts shaking. So I mean, I can't predict where this will go, because somewhere outside he came out with a research report that look this group is going to go down, and I hope you understand what I'm saying.
Yeah. No, what I am saying is that, you see, my point is very simple. As a statutory auditor, one should not be influenced by views of others unless these are supported by, like if you recall the instance of one company being accused of a lot of malpractices, and it turned out that the research was done by a non-discrete firm in the US, which was itself subpoenaed. I mean, the Supreme Court of the Securities Commission, the US, had penalized the firm for short selling. So therefore, if shareholders are going to be influenced by information which is not authentic, then equally the auditor should not be influenced by such information unless there is a certain amount of authenticity. In any case, as I said, his views on the going concern or on the fair and true view of the state of affairs should not be influenced so much by external opinion as much as his own judgment. We are aware that there is a concept in the US. In fact, we have in India also the similar concept in specific sections of the law. There, there is a concept of a best judgment rule. See, whenever the board operates, functions, the board is always supposed to assume a role which is fiduciary in nature. So the board's actions are prima facie not questionable as long as the judgment, the decision that they have taken answers to the rules of the best judgment rule. In fact, in the US, this is called the Delaware rule. And you can find the similar mention in the Companies Act of 2013. So therefore, that's a short point I want to make, that the auditor should be led by his own views and should not be influenced by the views of others, unless it is a report for the government which is authentic. Then, of course, there needs to be a consideration of that, but not unverified information.
Thank you, Mr. Kalidas. Very, very informative. Yeah, no, you can continue. Yeah.
Yeah, so the second specific company-specific information which needs to be disclosed in the board report. So we have already discussed the financial summary and the highlights. And the second information that has to be that amount which the board proposes to carry any of the reserves. So the amount which is proposed to be transferred to any reserves of the company, if no amount is proposed to be transferred to the reserve, a statement to that effect shall include, apart from the statutory obligation under section 3 of section 134, which mandates the company to disclose the proposed amount for the reserves, and the standards also necessitates the including a statement in the report. So a disclosure should be made if no amount is proposed to be transferred to reserves of the company. So for instance, we have given...
I'll just interject for a small 1 second. I will interject on this transfer to reserves. See, this is a departure from the 1956 Act. The 1956 Act provided for a statutory transfer of a certain percentage of the current profits to the general reserve. Now, this requirement is not any longer applicable under the 2013 Act. And secondly, when you transfer to a general reserve, as per the law under 2013, if you want to declare interim dividend under section 123, interim dividend cannot be declared out of reserves. You can declare interim dividend only out of current year's profits or past profits which are transferred to surplus in profit and loss account. If you look at Schedule 3, there is a distinction between the disclosure of amount appearing as credit to profit and loss account and reserves and surplus. Credit to profit and loss account, although it's in the nature of an undistributed profit, it is not to be considered as part of general reserve. It is a free reserve which has not been identified for any purpose. So the correct, the practical way out of this situation for a company secretary is to propose to the board, do not transfer any amount to a general reserve. If you want to have flexibility, keep the amount undistributed to the credit of the P&L account, right?
Yeah.
So if no amount is transferred to the reserve, the following statement should be included in the report: that the board of directors of your company has decided not to transfer any amount to the reserves for the year under review. So this has to be made in the board report. So next specific information which needs to be disclosed is the change in the nature of business in case of commencement of any new business or disposal of any existing business. So in case the company has commenced any new business or discontinued, sold or disposed of any of its existing business or hived off any segment or division during the year, the report should disclose the detail of the same highlights and the key focus area. And the standard provides further clarity by prescribing the aspect on which the disclosure should be made under this heading as commencement of any new business or discontinuance or a sale of disposal for its existing business and the hiving of any segment during the year. So this will offer the investors and stakeholders of the company a consolidated view on the changes that have occurred in the business scenario across the company.
No, just 1 minute, Nayan. Let's go to the previous slides. See, when you say, if I'm a private equity firm and, I do regular investments and, and during the years, I exited, some of the investment. So does it that, I should be highlighting in my director's report, look, out of those 30 investments, 2 companies I've exited.
Can I interject here?
Yeah,
See,
please.
if you are a firm which is into equity investment, it is the equity that you make investments in companies. Those are actually forming a part of your stock in trade. There's a difference between stock in trade and investments. Investments, when you make investments, there's a certain presumption that investments are intended to be held for long periods. But if you are a trader, if you are buying and selling stocks, and your character is that of an investment company, that is not considered as investment. That is to be shown as part of stock in trade. So it will be like, in and out where it comes. You will indeed mention about the details of the trades that you have involved, but you don't have to show it as part of your investments, right?
Okay, thank you, sir. Yeah. Vinay.
So if there is any material changes and commitments which is affecting the financial positions of the company, so this has to be recorded in the board report. So the effect of such a changes and commitments and an estimation of their financial impact shall also be disclosed in the report. So if evaluation of such an estimate cannot be made, a statement to that effect be made. So the causes for such material changes and commitments and the remedial measures taken shall also be disclosed. The report must also include the information regarding the changes in the external and the internal environments, encompassing the technical, legal, and financial aspects, as well as any disruptions such as strikes, lockouts, breakdowns that have impact the company's operations. So the standard provides that the effect of such changes and commitment and the estimation of their financial impact should also be disclosed in the report. If evaluation of such an estimate cannot be made, so to that effect, so the causes for the remedial measures taken by the company can be disclosed.
Now, here one important point which I want to convey, which has a huge impact on reporting for cement companies, which viewers should know. See, cement companies, particularly there are 11 top cement companies in India, which have been slapped some 7-8 years ago by the Competition Commission for practices which are supposed to have rigged prices. They are supposed to have indulged in anti-competitive practices, unfair trade practices, by which through cartelization. So the Competition Commission of India has imposed on all the cement companies. In fact, the highest amount of penalty which has been imposed is on Ultratech, which is about 1,700 crores, followed by ACC, Ambuja, etc. Now, all these cement companies have taken up the matter. They have appealed against the Competition Commission's ruling, and the matter is now with the Supreme Court. The Supreme Court has even postponed they have even stayed the collection of the demand. The matter is before the Supreme Court. Now, when you're talking about the impact of, orders, now this is an example of a very, very significant of an event which will have very significant events on the fortunes of cement companies in case the Supreme Court decides to uphold the decision of the Competition Commission. They will have to book the liability in their accounts. So therefore, in your reporting, you must mention about what is the status of such legal disputes, to what extent is it likely to materialize or otherwise, so that it becomes an extreme. And materiality threshold for a listed company should be the threshold as laid down under Regulation 30, namely 2% of net profit, 2% of consolidated turnover, 2% of net worth, or 5% of absolute profits. Whatever is the threshold which applies. Okay. Go ahead, please.
So any kind of a penalties.
Yeah. So another information which needs
just a minute. So any kind of penalties. So one was a penalty, of course. This was levied across the industry. But if you're a bank, like I'm a State Bank of India, left and right, the RBI put some kind of a penalty because somewhere I'm not followed. So those also has to be highlighted.
Yeah. Now let me say this. in fact, there is a problem in the listing regulations insofar as the imposition of penalty is concerned. Now, there is no materiality threshold insofar as penalty is concerned today. So therefore, you will find that even if there is a reporting on penalties, I've seen Yes Bank have made a disclosure of a penalty of 100 rupees by RBI. And if you recall, in Reliance Industries, there was a reporting to the stock exchange of some 40,000 or odd figure, which was imposed as a penalty by the GST authorities. And that actually, in terms of materiality, it was the 4th decimal place where it comes to the percentage of the consolidated turnover. So therefore, there is an issue with regard to what is material for disclosure. Now, I would say that given the fact that there is no materiality threshold, you should capture anything which is material from the standpoint of financial impact and not capture things like 100, etc. And in fact, if you see, the expert committee of SEBI appointed to review the LODR requirements have now recommended that there will be some financial threshold. They have said that if a penalty is imposed by a regulator, like for instance, in the case of bank, if RBI has imposed a penalty, the threshold will be any penalty of 10,000 or more. And if it is by any non-regulator, the threshold will be 10 lakhs or more. So we will see some clarity in this area, but so far there is nothing. But to my mind, if you try to include all the penalties that have been imposed, that will be absolutely meaningless from the standpoint of the shareholder. So I would say that you should apply discretion where it comes to, again, you should not confuse yourself with the problem which NDTV had to confront some years ago. NDTV had a tax demand of 2,000 crores from the income tax department, and they did not make a disclosure to the stock exchange because they were confident that the demand would be vacated. SEBI imposed a penalty of 2 crores of rupees. Eventually, it turned out that the penalty or that the demand was not tenable. I mean, the demand was dismissed and NDTV won their matter. Then they said that this is the reason why we did not disclose. Now, SEBI said that, okay, you had your point, but the fact of the matter is that a 2,000 crore penalty is not something which can be wished away. So you should have disclosed. Okay.
Yeah. Yeah.
Yeah, so another disclosure is details of revisions of financial statement or the report. So in case if the company has revised its financial statement or the report in any of the 3 preceding financial years, the detailed reason for such revision shall be disclosed in the board report of the year, as well as in the report of the relevant financial year in which the revision is made. So the said section further provides the revised statement or a report shall not be prepared or filed more than once in a financial year, and the detailed reason thereof shall be disclosed. So the next information is a dividend for the dividend. And before giving you the insight on that, let's discuss about the dividend. Like section 2, subsection 35, the Companies Act defines the term dividend as any distribution of a profit by a company to its stakeholder, whether in cash or in kind. It includes the bonus share, but does not include the distribution of the assets on the liquidation of the company. So section 123 of the Companies Act lays down the provision for the declaration and the payment of the dividend. So according to this section, a company may declare and pay the dividend only out of the profits of the company for the year on or any previous years after providing for depreciation or out of a profits of the company for any previous years. So after providing for the depreciation and setting aside an amount for the reserves as may be prescribed. So the company is required to give the information in the board report, the amount of dividend per share and the percentage thereof which the board recommends for the year and the dividend distribution tax thereon. In case no dividend has been recommended by the board, a statement to that effect shall be made. And the board can propose the dividend to be declared by the members during the AGM, adhering to the company's dividend distribution policy if applicable, without the board recommendation. So member cannot independently declare any dividend during the annual general meeting. So the disclosure for
I have to interject you on a very important point here, because
Yeah.
some of the viewers may have this confusion in their mind. No, the term dividend has been defined inclusively under Section 235 to include interim dividend. Now, interim dividend is a prerogative of the board. The board has the authority to declare interim dividend under Section 123(4). On the other hand, the final dividend is to be only recommended by the board and shareholders are supposed to approve. The question, therefore, is that if the board has declared an interim dividend during the course of the financial year, the question is whether that declaration will have to be actually ratified by the shareholders in the annual general meeting. Why I'm raising this question is that if you look at Section 102(1), it says that what are the items of ordinary business? The items of ordinary business include the declaration of any dividend. So therefore, the law has not been actually appropriately amended to provide for this express authority which has been given to the shareholder, to the directors for declaring interim dividend. So even if you go by 102(1), the requirement is that even the interim dividend which has been declared by the board has to be ratified by the shareholders. Of course, there are two, schools of thought on this. The conservative view, which is taken by companies like TCS, is that even I have seen TCS's annual report. They always recommend the ratification of the interim dividend. There are certain companies which do not take on this requirement of getting the ratification. And the secretarial standard on dividend also says, our standard says that the interim dividend declared need not be ratified by the shareholders. But my view on this is that law has to be read as it stands. So 102 having not been amended in conjunction with 123(4), to my mind, the conservative view is to ratify the interim dividend also. Go ahead, please. I'm sorry if I'm making interjections so often.
No, that
No,
is your
it's
prerogative.
No, Mr. Kalidas, you are actually most welcome. You are free to interfere anytime and said that the whole idea is only dissemination of the knowledge between amongst us. That is the whole idea.
Okay.
Yeah. So for example, for instance, like how the declaration has to be made, a dividend of ₹7.50 per equity share of the face value of ₹5, each would indicate that dividend of at the rate 150% has been recommended by the board. So we have to mention the percentage while making the disclosures. So the amount and the percentage of the interim dividend declared, if any, during the year, and the dividend distribution tax thereon. So we have to given this disclosure in the board report. So the board of directors. So the board of directors of the company has declared the interim dividend at any point of time within a financial year, including the period from which the closure of the financial year to the AGM. So once declared by the board, no further approvals or ratification at the general meeting is necessary. However, the company's report should explicitly state the amount of interim dividend declared and paid during the year. So for instance, like how we have to declare it, the board of directors of your company, after considering the company's dividend distribution policy, has declared and paid an interim dividend of rupees this per equity share of the face value for rupees this, each at the mentioning the percentage during the year. So the amount of rupees dash was paid as dividend distribution tax on the interim dividend, which is to be declared by the board. So this is the statement, the way which we have to disclose the interim dividend in the board report. And there is a total amount of dividend for the year. The report should also disclose the total cumulative dividend amount comprising both the interim dividend declared by the board and the final dividend recommended by the board. Then the payment of the dividend from the reserve. If the standard requires
Nayan, there is a comment from the participants that at moment there is no dividend distribution tax. It is only TDS.
No, dividend distribution tax is now shifted to the
but for company it will is not there, no. Yeah, so for company it is not there, no.
Yeah, company it is not there. It is to be borne by the person who's receiving the dividend. But the only thing is, in cases of the dividend which is exceeding 5,000 rupees, they'll have to deduct the TDS at the source. And he will get the credit.
The participant Amit Bhai, thanks a lot, Mr. Amit Bose, that there is no DDT, it is TDS.
Yeah.
Correct, correct.
Yeah,
It is-
thanks,
it is
thanks
a
for
very-
thanks for correction. Thank you.
The
Apologize.
other point, Deepti, since you raised this point, the other point which I want to share is that, we are talking about dividend and we are essentially talking about equity dividend. Now, the question is that whether dividend also includes dividend on preference shares. So even if there is a preference, the dividend which is payable as per the terms of the issue, to my mind, when there is a declaration of equity dividend, then prior to that, there should be, there is no case of interim dividend for preference shareholders. So if you've got preference capital, you have to actually take the approval of the shareholders for the distribution of preference dividend also.
Yeah, absolutely right. Absolutely right. I 100% in agreement with you. Although many people will say it is actually a committed amount, which will be the, what you call the long-term borrowing cost as per the IFRS, but still declaration by means of the dividend is actually the prerogative of the shareholders. It has to be declared. Yeah.
Thank you, Mr. Amit. Really appreciate your contribution. Yeah, Nan, go ahead. And participant, apologize for this. Thank you.
So one declaration is to be there for the statement on compliance with the dividend distribution policy. So the SEBI, by its notification 8 July 2016, inserted Regulation 43A to the listing regulation, making it mandatory for top 500 companies to formulate a dividend distribution policy, which includes the following parameters: the circumstances under which the shareholder of the listed company may or may not expect the dividend, the financial parameter that shall be considered while declaring the dividend, internal and external factor that shall be considered for the declaration of the dividend, and the policy as to how the retained earnings shall be utilized, and the parameter that shall be adopted with regard to the various classes of the shares. So the major events that occur during the year, it should be there in the disclosure, like the statement of the company's affair, which covers the segment-wise position of the business and its operation, change in status of the company, key business developments, and changes in the financial year. So there should be a detail of acquisition and merger, expansion, modernization, and diversification, developments, acquisition, assignments of immaterial intellectual property rights. So under the heading, the disclosure should provide a concise description of the company's business nature, highlight the growth in terms of the key product and service volume, structural business changes, and developments in the IPR, joint ventures, strategic business and technological agreements, disinvestments, mergers and acquisition, which is executed during the year. So for the listed companies presenting the consolidated financial statement, it is essential that key highlight also encompasses the significant events which is concerning the subsidiaries that have influenced the company's overall state of affairs. So there are some general information which needs to be provided, like overview of the industry and important changes in the industry. What are the external and the external environment and the economic outlook? Induction of the strategic and the financial partners during the year, particulars of the delisting activities, giving details like price of the offered pursuant to delisting offer period of the delisting, number of shares tendered or accepted, and total consideration paid and holdings of the promoters. Sir, anything you would like to give insight on?
In that case, there is one question, Mr. Bala, that as regards the statement is made that production will start in years, but the production is not started. Whether it is a material, I will just correct that. Is that a material? That is the projects getting delayed by 4 or 5 years should be considered as material changes affecting the financial.
Mr. Kalidas, you are muted. You are muted. So can you unmute yourself, please? Yeah.
In fact, in my view, if there is a delay in the commencement of commercial production, or if there is a delay in the completion of the project, the board should make a clear explanation as to why there is a delay in the production or why there is a delay in the project, and what steps are being taken for the purposes of mitigating the problems that have been associated with the project implementation. And third area, which is extremely important, when we talk about macro parameters, is the risk factors. You see, the risk factors, there are risk factors which are internal to an organization. There are risk factors which are external to the organization. Now, out of the external risk factors, there are certain things which the organization can have control over. There are certain which you cannot control. Like, for instance, if there's a flood or an earthquake or whatever, you cannot have any control. So that's not a factor which the board can take steps towards ensuring that does not happen. But surely, where it comes to an external risk factor, like for instance, typically because I was in so many years, I was in cement, I can tell you that limestone reserves for a cement company are extremely important. And limestone is not something which, it's not like a plant. It's not like a tree or something where you take out the limestone and the limestone grows. It does not happen. It's a wasting asset. So a cement company has to particularly make an estimation as to the reserves that are available for limestone, how long it will last for the company. And if there is depletion of resources, what action is being taken? You must either look for limestone reserves elsewhere, or you should look at importing or buying limestone and things like that. So these are the areas which the board has to actually comment on where it comes to the factors that impact the growth of the business. Okay.
Again, one more thing which comes to actually, again, it depends upon the type of the company as well. Because if it is a listed company, there is a separate section in their management discussion and analysis report where you are actually expected to discuss the threats and opportunities. As you rightly said here, suppose this is the listed company. The listed company, there the project is actually, proposed it should begin in the particular year. You would have definitely indicated that in the management discussion report. This is what the company's future plan is. This is the opportunity which is going to be the case, etc., which you would have definitely disclosed it. When you say the project is delayed, obviously the updation has to come. Again, as Kalidas puts it, the reason being there, what are the steps are being taken, when it is expected, how it will impact the company's business, that is required to be disclosed.
Thank you. Nan, you can go ahead.
So for the listed entity, again, if there is a credit rating of the security, so the credit rating is an assessment of the probability of the defaults on the payment of interest principals on an instrument. So it is not recommendation to buy or sell or hold the instrument. Rating only provides an additional input to the investors, and the investors is required to make his own independent objective analysis before arriving at any investment decision. So the board report should contain the following information under this head: that the credit rating obtained in respect of various securities, name of the credit rating agency, date on which the credit rating was obtained, and the revision in the credit rating, reasons providing by the rating agencies for downward revision, if any. So as per the listing regulation, listed companies are required to disclose in the corporate governance report a list of all the credit rating obtained by the company along with any revision thereto, so during the relevant financial year. So for a debt instruments of such entity or any fixed deposit program or any scheme of proposal of the listed entity involving the mobilization of funds, whether in India or abroad.
Here I would like to interject and say that where it comes to revision in credit rating, companies are not actually very, very keen to report on downward rating. They don't want to disclose. And more importantly, they confine themselves to a disclosure on the revision where it comes to the method, the rating, say AA plus has been downgraded to AA minus. There is a connotation, there is a reasoning associated with the downgrade. Companies are not willing to share the reasons as to why their instrument has been downgraded. Now, for this purpose, SEBI have proposed in the recently, the report of the expert committee on LODR revisions, which was released on 26th of June, SEBI have said that rating agencies should provide the information directly to the stock exchanges where it comes to any revision in the rating, so that the companies are not in a position to camouflage or manipulate the revisions in rating.
So, Mr. Kalidas.
Yeah.
this rating also includes your bank rating? Because see, most of the company, they borrow money from the bank, and all those banks, they have their some rating, for the company.
Yeah.
So are this rating also is supposed to be told? Because so when you say rating, when you are issuing some instrument
No.
like debenture and all.
Atul bhai, I think here this is the report of the company. So therefore, the rating will be actually the report on rating will be of those instruments which have been issued by the company, and
Okay.
not so much about the rating of banks from which they have. Of course, if there is a bank which from which you have in which you have placed a huge amount of deposits which is on the run, now that is something which has to be reported as a matter of material information. But to my mind, the reporting on rating is only restricted to instruments which are issued by the company. Okay.
Kalidas, I got one question.
Yeah.
You remember some years back when this corporate governance was talked about it, the rating was actually given for the corporate governance rating also.
Yes. Yeah.
When the corporate governance rating was actually started, some of the companies, they decided we don't want to accept this rating.
Yeah, actually, you see, I'll tell you what.
Yeah.
You can't. Corporate governance is a very subjective matter.
Yeah.
It is not something which can be measured in the same way as the ability of a company to finance or refinance or to service its debt obligations. Now, given the fact that there are several subjective decision areas in corporate governance, it was actually considered as a non-starter from the beginning. It was made optional. I recall that the one of the few companies which had their corporate governance rated was HDFC. But eventually it was decided, see, rating is specific to an instrument. You can't rate a company. You can
right. Do you have a choice when it comes to the securities rating not to accept?
No, you have a choice. You may not accept it, but the fact of the matter is that you have to disclose it just the same. You can say that we don't accept the rating as a part of reporting, but you have to report what is the rating that has been awarded.
Okay, because earlier in the corporate governance rating, you don't even have to disclose it. That was the case. Yeah, that is why.
No, that's true. That was optional. This is rating is compulsory, and this is specific to instruments. That's why you don't even rate equity. Equity rating is not also easy to, because there is nothing to be serviced, like unless you assume that dividend is supposed to be serviced every year. Okay.
Okay. Thank you.
Kalidas, we have added Mr. Amit Buch, who is the company secretary of Navneet Publications. Probably he has many things to suggest. Yeah, Amit bhai, you are unmuted. You can always intervene.
Yeah. So good morning and hello to everybody, all professional friends and seniors. See, as Atul bhai raised this question of mentioning the credit rating by the banks. See, I've seen a couple of companies, including my own company. I do mention, and my auditor also, who is certifying finally this corporate governance report, to mention the rating given by the banks, because it will also affect the company's payment or the working capital facility if there is a downgrade of the rating.
Yeah.
So as Mr. Kalidas said, it may not be required, but my personal view is good to report even the bank credit. We don't lose anything.
I appreciate that, but the point I'm making is that, you see, working capital actually is dynamic. Today, you may not be using working capital limit at all. In that case, what do you report? So, whereas there are situations where if you are a cyclic industry, you may be using working capital to the maximum. So, working capital, it's dependent on the dynamics, immediate dynamics. There is no issue of a instrument such as a debenture or a bond or a whatever debt instrument or a commercial paper. So therefore, to my mind, yes, indeed, you may report on the rating made by the bank where it comes to their perception on the exposure given to the company, but that is my way of an additional information to my mind.
Yeah, that is right. Though it is not mandatory, one can always go beyond the regulation. They can make a disclosure. That is there. Yeah.
We can take this, something, so suppose, I'm a NBFC company. And so for me, I mean, it is a good idea to inform the exchange, because ultimately my business, is into, like, see, I'm a director in a housing finance company. Sometimes, my bankers, they appreciate, I mean, so they give a good rating. And sometimes, after 2 years, they say, look, you are not up to the mark, so we are reducing your, and this affect, the borrowing capacity of the company. Yeah.
I agree with you. In fact, you see, Tulbai, it is like this. Where it comes to disclosure, the rule that you have to follow, to my mind, this is of course a thumb rule, but this is a very valid rule. The rule that you have to follow where it comes to disclosure is, when in doubt, disclose.
Okay.
When in doubt. So if you want to disclose something by way of a precaution, you're always free to do so. At the same time, if you don't report, the point is that it's not mandated. But if there is something alarming which is affecting the business of the company, then it should be reported.
Okay, great. Thank you, Amit Bhai, for your nice thing. Yeah. So we have unmuted you, so anytime, you can intervene. Yeah.
Thank you so much.
Yeah, Nan, you can continue.
Yeah. So another disclosure is about the capital and the debt structure. Capital structure refers to the mix of financial resources, which is including both equity and debt, which is utilized by the company to fund its operation and supports its growth. So it represents how a company chooses to finance its activity through a balance of shareholders' equity, which represents the ownership, interest, and the debt, which includes the loan and other forms of borrowing. So the strategic allocation of the fund is crucial as it directly impacts the company's financial stability, risk profile, and the cost of capital. So the board report should contain the following information. Is there any change in the capital structure of the company during the year? So in order to facilitate the uniformity in the disclosures, the standard laid down that the change in the capital structure of the company, which is required to be disclosed in the report. So the information should be sufficiently detailed and should also cover the class of share across which such changes have been carried out.
So do we have any accounting standard on a director's report? I don't think so. Yeah. No. You are muted. Mr. Kalidas, you are muted.
Now, I wanted to say here, we are talking about change in the capital structure. Now, it is not only restricted to an increase in the capital or a reduction in capital. Even if there is a buyback, which has been made during the course of the year, that also represents a change in the capital structure, and that should be reported.
Yes, sir. So also in the case of the shares or other convertible securities, if there is a change, then it also has to be reported. And is there is any issue of equity shares with the differential rights, issue of sweat equity shares, issue of warrants, and details of the ESOP, employee stock options, yes, it's there, and shares which is held in trust for the benefit of the employees, where the voting rights are not exercised directly by the employees. So these information there, by the way of change of equity or the debt, should be disclosed in the board report.
When it comes to disclosure of shares held by a trust, please consider one aspect. The trust has to make a declaration of beneficial interest as per the requirements of Section 89. That is a major, of course, it may not be directly related to the topic that we are discussing. Since you are talking about shares held by a trust, if the trust is the beneficial owner, then there is a requirement to satisfy the requirements of significant beneficial ownership rules. Okay.
Yeah. So this also not apply to the in the case of the listed company, as in such cases the SEBI do not allow the trustee to vote. So therefore, in case of the listed company, so where the trustee holds the shares, the details as mentioned in should not apply. And in the case of debentures, bonds, or any non-convertible securities, the disclosure has to be made that the company has issued the aggregating of rupees dash pursuant to the SEBI circular on the fundraising dated 26th November or whatever the date is. It has to be specified, and the norms and the disclosures by the large listed entity they should also fulfill the condition which is mentioned in the circular given by the SEBI in November 26, 2018. Investor Education Protection Fund. if the company EPF is initiated by the central government under Section 125 the Companies Act with the primary aim of safeguarding the investors. So if there is any the details of transfers, there are following details which is to be mentioned in the board report while making the transfer to the IEPF during the year, like whatever the amount of unclaimed unpaid dividend and the corresponding shares, redemption amount of the preference shares, amount of mutual deposits for companies other than the banking company along with the interest occurred thereon, amount of matured debentures along with the interest occurred thereon, and application money which is received for the allotment of any securities due for refund along with the interest accrued, and the sale of proceeds of fractional shares arising out of the issues of bonus shares, merger or amalgamation. An year-wise amount of unclaimed dividend, which is lying unclaimed amount to up to the year and the corresponding share. So the amount of donation, if any, given by the company to the IEPF, and such other amount which is transferred to the IEPF during the year has to be disclosed in the board report. So as a good governance practice, the company should disclose these amounts, if any, which have been transferred during the year to the IEPF. So Secretarial Standard 3 issued by the ICSI requires that the annual report of the company should disclose the total amount which is lying in the unpaid dividend account of the company in respect of the last 7 years, and when such unpaid dividend is due for the transfer to the fund. So it is suggested that the details of shares transferred to the IEPF during the year should be mentioned in the report. So if any benefit such as bonus, stock split, consolidation, or financial entitlement are occurred on the shares which is to be transferred to the IEPF, then detail of such benefit transferred to the IEPF should also be mentioned in the report. So in addition to the above, it is suggested that the company should disclose the date and the year of declaration of dividend and the amount to be transferred to the IPF, and the amount of dividend, if any, which is transferred by the company to the IPF during the year should also be disclosed. Another point is for the disclosure to be there to meet in the board report is management. So if there is a change in the director's KMP or the disclosure has to be made. So like how many appointment or the cease to be director KMPs or during the year, appointment or cease to be directors KMP after the end of the and after the year end up to the reporting date. So mode of such appointment, cessation, name of the director, retiring by the rotation, and the ensuring annual general meeting. So as a measure of a good corporate governance practice, the standard has extended the disclosure requirement to include the persons who have been appointed, ceased to be directors, KMP of the company after the end of the year and up to the date of the report. So in addition, the standard also requires that the mode of such appointment and cessation should be disclosed in the report. And in case a listed company which has listed its specific security, the corporate governance report should state the detailed reason for the resignation of the independent directors who's resigned before the expiry of his tenure, along with the confirmation by such director that there is no other material reason other than those provided.
Now, this is very tricky, Mr. Kalidas. Just go to the previous slides. See, many of your KMPs, they resign.
Yeah.
You always have a reason to say, look, I'm just for my better growth or better sphere. And so he can't write, look, I'm resigning because, I'm forced to sign certain document which I'm not comfortable. So, of course, so this is only on prima facie case, which has been, given to the letter to the board of directors, right? See, that has to be taken it, to the.
I see your point, Atul bhai. I see the point, but then there is a catch here. Now, when I am giving the reasons for my resignation, I have also to confirm to the board that apart from the reason which I have adduced, there are no other reasons for my decision. So you must be truthful to the extent possible. I mean, it is not possible any longer to give a very cryptic reason that I'm going for better prospects, or I'm going because, I'm retiring, or I'm going for health reasons or whatever. So to the extent possible, you must give the reasons. I quite agree with that. Where it comes to a KMP, I cannot tell the company that I'm unhappy with the manner in which the accounts have been drawn up. So therefore, I don't want to be participating in that process. So because that is going to endanger my career. But look at the disclosures which are happening where it comes to independent directors. Very recently, you must have come across the resignation by an independent director in Suzlon. Suzlon Energy had an independent director who resigned. And he resigned because he was not comfortable with certain board decisions. And he made it known in the letter to the stock exchange. And the company had no choice other than to attach a copy of the resignation. So today, the stock exchanges and the shareholders actually want to know, like Arnab Goswami would say, the nation wants to know. Similarly, the shareholders want to know what is exactly the reason why this has happened. So you cannot be very, you cannot camouflage the reasons by a very, very cryptic better prospects and things like that. And more, there is one quarrel I have with this disclosure, requirement is that in the corporate governance section, there is a requirement of where it comes to the independent director. You see that the board's report is a compilation which is happening after the end of the financial year, right? Suppose I have as an independent director, let us say in the year 23-24, I resigned in May of 2023. And I gave the company the copy of the resignation letter and the company published it in the stock exchange. Now in the CG section of the annual report, it is necessary, not only it is necessary to again mention about the resignation by the director, and that has to be backed by a confirmation by the independent director that the reason as given by the company are the same reasons for which I have resigned. Now, here there is a practical difficulty. I told you that the resignation happened in May 2023. Now, the report of the board is happening sometime in June of 2024. In between, the independent director may have died, may have left the country, may not be traceable, may not be wanting to give that confirmation. So to my mind, it is a good idea for SEBI not to ask the company to repeat the reason because they have already given the reason for the resignation while making the disclosure to the stock exchange.
So when you receive a letter, such kind of a letter from an independent directors showing a concern about the operation of a company, and he's resigning. So as a company secretary, am I duty bound that I should be attaching letters and sending it to the stock exchange, or I just simply say, look, so and so directors has resigned, from the company?
No, there is no choice, Atul Bhai, anymore. You are supposed to give a copy of the communication received. And that is why, companies are becoming extremely careful in handling independent directors so that they do not come out. In fact, there are cases where even secretarial auditors have been implicated by outgoing directors on the ground that they have not reported adequately on the non-compliance by the company. So I think it's a matter where there is no choice here. The moment the company, you see, the law says 168 says the resignation is complete once the resignation is known to the company. So there is no question of even acceptance by the board. That's a matter of courtesy. So resignation is a unilateral act. So once the director resigns and communicates to the company, that's the end of the matter. You are supposed to inform the stock exchange along with a copy of the resignation, adducing the reasons for the resignation.
Yeah, LODR makes it very clear the letter has to be attached, it has to be sent to the stock exchanges. So there is no choice at all for you.
Okay. Yeah, Nan, you can continue.
So the independent director's declaration regarding the independence and compliance with the code of conduct, and it should be disclosed in the board report. So then next is the board meetings, stating the number and the date of meeting of the board held during the year. So the number the dates of the meetings, which is an important disclosure, is not covered in subsection 3 of section 134. And many companies make such disclosures voluntarily to give the complete information. So in order to promote the uniformity in the disclosure, the standard requires that both number and the dates of the meeting should be disclosed in the report. So the committees, the composition of the committee, number and the dates of meeting, the standard requires the disclosure of composition of all the committees constituted by the board under the Act and the listing regulation. The changes in the composition of such a committee during the year should also be disclosed in the report. Similarly, to the disclosure requirements of the board meeting, the number and the dates should also be or the
Nayan,
meeting such, yeah.
Here I just wanted to interject where it comes to change in the composition of the committee. You know, the LODR requirements have been silent on if suppose there is a resignation of a director from a committee, the report, the LODR provisions are silent as to the time within which the vacancy has to be filled up. Now, this position, this lacuna has been addressed by the expert committee on LODR in its report, and they have said that if there is any vacancy in a committee constituted by the board, that vacancy should also be filled up within a period of 3 months. Okay. So you don't have the choice of continuing with an audit committee which is not properly constituted upon the resignation of a director.
Okay, sir.
You have a
So,
situation where, audit committee says, look, this item, because of certain reason, as an audit committee, we are not been able to decide and say, this goes to the board of directors. So, I mean, is it a correct way of doing this, or so?
No, that's exactly the point I was making. See, the audit committee could say that we have not been able to find a suitable candidate. Now, therefore, we are unable to find the replacement. Now, the point is that replacements have to be found necessarily. And that is why the expert committee has said that as much as I give you a window of 3 months for substituting a director who has resigned or has died, the same way I shall be given 3 months to fill the vacancy in a committee. Okay, you cannot carry on with the committee which is lopsided. And the audit committee, there is a composition which is laid down not only under section 177 but also under the LODR. So 2/3 have to be independent. So you can't have a situation where the number of the audit committee, the composition has been disturbed to the extent of not having 2/3 of independent directors. Now there is the compulsion to appoint within 3 months.
So there is another recommendations of the audit committee where the board has not accepted any recommendation of the audit committee. So the statement to that effect shall be disclosed in the report along with the reasons for such non-acceptance. And in case it is a listed company where the board has not accepted any recommendation of any committee of the board, so which is mandatory requirement. So that financial year, the same should be disclosed with the reason in the CG report. So company's policy on directors' appointment and remuneration, it should also be there in the board report. And in some of the cases, it is sufficient to disclose those features on the website of the company as well. So the board evaluation. So the report of every listed entity, company and other prescribed class of public company shall include a statement indicating the manner in which the formal annual evaluation of the board performance, its committee and individual director has been made. So the requirement for the performance evaluation applies to every listed company and every other public company which is having a paid up share capital of 25 crores. And as per the provision of subsection 2 of section 178 of the Act, evaluation of the performance of the board, its committee, individual directors can be carried out either by the board by nomination or by remuneration committee or by independent external agency. So the directors establish effective system for the compliances with applicable laws, ensuring other operate adequately, and the directors of the listed company establish and ensure the effective internal financial control. And is there any fraud reported by the auditor? That has to be.
On evaluation of the board, I have a perspective which actually is a chink in the law. Atul bhai, please note, see that the law now says that the evaluation, whether the evaluation has been carried out of the board, has to be reported. Okay, and whether the parameters for evaluation are internally developed or whether it has been done by an external agency. Now, the report, the requirement is not to make a, you are not required to make an evaluate the whatever has been, how the directors have been evaluated. Now that information is no longer, is not required to be shared. You only need to state whether an evaluation has taken place. To my mind, it is important for the shareholders to know how the independent directors have been rated in terms of their performance. And therefore, the law should be complementary in the sense of making it compulsory for the company to disclose also the evaluation. See, the one of the requirements of the independent directors also is to evaluate how well the chairman is allowing the conduct of business, whether he is allowing participation of the independent directors in a fearless manner, whether the reporting on secretarial requirements is adequate, whether they are receiving adequate information for articulating on contentious issues, etc. So all that, notwithstanding that there is no requirement in the law to share that information with the shareholders, to my mind, as compliant company secretaries, we need to report on these matters. And I think I'll be very happy once SEBI stipulates that the evaluation, the details of the evaluation of the directors should also be shared with the shareholders.
See, we also have done a couple of evaluation in Mehta and Mehta, sir, and most of the time the suggestions was that the directors has to be updated regularly and there has to be some proper training for the directors.
Correct.
These are the normal standard suggestions, and some of the directors has not attended meeting, so the suggestions that he should be vigilant and he should be participating, being you are as an independent directors. So, but that's all. I mean, so you could just can't if you have done some evaluation from outside, you can't write those adverse, this thing. Look,
But tomorrow it is going to happen. That I can tell you.
Regulator will definitely going to come back on this. They will definitely would like the shareholder to know what is the performance of the director, whether they are spending enough time, whether they are deliberating, whether they are really independent, whether they are restricted. All those things will be required. That is why, as Kalidas puts it, I also foresee this is going to come in future days. It is only the question of time. Today, there is no requirement. Today, you have to only report you have done a board evaluation. That's all. You have a mechanism to do evaluation. You have done the evaluation. Whatever choice you have, that is okay. But what is the outcome of the evaluation? That is not required to be disclosed today, but it will come.
By way of input, let me share with you that when I was in ACC, the evaluation of the directors, of course, was shared by the chairman with the directors in separate emails, which of course, no, everyone did not have an access. Suppose one independent director was rated, on the basis of the parameters laid down, his evaluation would be shared by the chairman with him, not with others. Okay, so that way we had a methodology by which the director came to know how he was being rated. However, it is another matter, how can you evaluate the performance of a non-executive functionary? That is a debate for a separate day. But then I think the day is not far off when you will have a requirement to share the information with regard to the evaluation of the directors.
And you can continue.
I lost the connection. 1 minute. I'm just starting. So if there is any fraud reported by the auditor, it has to be covered in the board report, like the nature of fraud with description, approximate amount involved, and the parties involved. If is there any remedial action taken, and if no fraud is reported by the auditor, and a statement to that effect shall be given in the report. And another disclosure is the remuneration of the directors, like how the number of permanent employees on the roll of the company, the ratio of remuneration for each director to the median remuneration of the employee of the company, the percentage increase in remuneration of each director, CFO, CEO, CS, and is there any percentage change increase in the median remuneration of employee in the year, average percentile, and name of the top 10 employees of the companies in terms of a remuneration drawn, and list of employees who earned at least 1 crore to 2 lakh rupees in a total for the year, and earned at least 8,50,000 rupees per month if employed for the part of the year. So such kind of disclosure is required in the board reports, and like a remuneration received by the managing whole-time director from the holding or a subsidiary company, and director's responsibility statement, which includes the annual account, were prepared following with the applicable accounting standards with the explanation provided for any significant departure. The directors applied accounting policies which is consistently and made prudent judgment and estimate to reflect an accurate financial positions of the company. And the directors maintained a proper accounting records to safeguard the company asset and prevent the fraud irregularities as given by the law. And the director had prepared the annual account on an ongoing concern basis. So these are the declarations to be there. Director's responsibility statement should be included in the board report. So there is a disclosures related to the subsidiaries, associates, and the joint ventures. So subsidiary is an entity which is controlled by another entity. So the control means that parent company can govern the financial and operational policies of its subsidiary to gain the benefit from the operations of the subsidiary. So control can be gained if more than 50% of the voting rights are required by the parent. So this is usually done by purchasing more than 50% of the shares of the subsidiary. So International Accounting Standards IAS 28. So they define associate as an entity over which the investors has significant influence. And the joint venture, it has been defined in the accounting standard IAS 28 as a joint arrangement whereby the parties that have joint control over the arrangement have right to the net assets of the arrangement. So the company is obliged to include the following information in the board report on the financial positions of the subsidiaries, associates, and joint ventures. In case of a company is having subsidiary, associates, and joint ventures, shall report a separate section highlighting their performance for each subsidiary, associate, and joint venture and their contribution to the overall performance of the company. For the purpose of harmonizing this disclosure with the annual report return, the information mentioned in AOC 1 should be as a part of the act. So companies shall have become or cease to be the subsidiary and associates or a joint ventures. And during the year or any time after the financial year's closure of up to the date, the detail of any newly acquired or established subsidiary, associate, or joint venture by the company must be disclosed.
Nayan,
And the
here there's a important information which needs to be shared where it comes to the accounting treatment of subsidiaries and associates. Where it comes to accounting treatment of subsidiaries, there is a consolidation which is line by line. The subsidiaries accounts are consolidated with that of the holding company on a line by line basis. On the other hand, if you're talking about associates, then the requirement is to determine the interest that you have in the associate in terms of 20% or more holding. And there is a concept called the pooling of interest method by which you recognize in your books, that means the consolidated holding company's books, you recognize that so much percentage of the profit or loss of the associate has not been considered in your accounts. So there is a difference where it comes to the accounting methodology for treatment of accounts of subsidiaries and accounts of associates. That you should, as a company secretary, be aware of.
Okay, sir. So the companies which have listed their specified security shall also state in the report the same of its material subsidiary as per the listing regulations. So if any such material subsidiary sold, disposed, or leased assets of more than 20% of the assets of the material subsidiary, so the standard the details should be should be disclosed in the board report. And another disclosure is the detail of deposits. The deposits, which serves a primary source of the funding for the companies and allowing them to secure the financial resources. So under the provision of the Companies Act, the companies have the authority to accept the deposit from their members as well as the general public as per the provisions of the Companies Act 2013. So the board report should encompass the following information, like detail of the deposit which is accepted during the year, deposits remaining unpaid and unclaimed at the end of the year, and default in the repayment of the deposits or the payment of interim thereon, and details of the deposit which are not in the compliance with the requirement of the Act, and detail of order which is passed by the NCLT or NCLAT. So these disclosures should be there in the board report. If is there any particulars of the loan, the company has to show like what are the loans given to the company or any person or the body corporate, given any security or provide a guarantee in connection with the loan to other person or the body corporate. So and exceeding the 60% of the paid up capital, free reserves and security premium account, or 100% of these free reserves and security premium account, whichever is more. So legal requirement is the approval of the board is required in all the cases, irrespective of the amount of loan, investment, and guarantee or security. The approval of board shall be obtained by the means of unanimous resolution passed at the board meeting with the consent of all the directors present at the meeting, and approval of the members by passing the special resolution, where the aggregate of the loan, investment, guarantee, or security altogether with the loan investment exceeds the limit as specified in 186(2), prior approval by the means of special resolution is necessary. So the content of the SR shall contain the total amount up to the which the board is authorized to make the loans, guarantee, investment, or security. Approval of the public and prior approval of the PFI should be there in shall be disclosed in the board report, and the rate of interest. No subsisting default with the respect of the deposit. A company which has defaulted in the repayment of any deposit which is accepted by it or in the repayment of its interest on the deposit.
Am I supposed to disclose then the rate of interest what I'm paying to the bank? The company
No.
should obtain the prior approval of PFI for which it has taken a term loan. The company directors also pass a resolution. And the rate of interest chargeable should be more than the prevailing years. Okay.
Yeah, see, that is because, where it comes to intercorporate loans, as per 186(7), you are not supposed to give to any company a loan which is interest-free in nature. So if there is an interest we charge, the rate of interest should not be lower than the rate as applicable to government security of, different tenure. Supposing you're talking about a period loan of, let's say, 1 year, the rate of interest shall not be less than the rate which is chargeable, which you will receive from the government security. But where it comes to borrowing from the banks, to my mind, there is no requirement for you to.
There is no requirement.
There is no requirement.
Yeah, nice.
Webinar, I'll call you after 1 hour.
So disclosures in the financial statement, the company shall disclose to the members in the financial statement the full particulars of any loan given, investment made, and guarantee or security provided, and the purpose for which the loan or a guarantee or security is proposed to be utilized by the recipient. The company which is registered under SEBI, a company registered under Section 12 of the SEBI and covered under such class or class of company shall not take inter-corporate loans or deposit exceeding the prescribed limit. And they shall furnish in their financial statement the details of the loan or the deposits. So the particulars of the contract, as per the Rule 15, the meetings of the board of its power deals with the particular of the contract and arrangement with the related party. So there are sub rules of the same which deals in various matters in the following way. As per Rule 15.1, the mandatory content of the agenda of the board meeting at which the resolution regarding the related party transaction is proposed to be moved, the name of the related party and the nature of relationship, the nature and the duration of the contract and the particulars of the contract or arrangement, the material terms of the contract or arrangement, including the value, if any advances paid or received for the contract or the arrangement, if any, the manner of determining the pricing and other commercial terms, both included as a part of a contract or not considered as a part of the contract. So whether all the factors relevant to the contract have been considered, if not, the detail of factors not considered with the rationale for not considering the factors, and any other information which is relevant or important for the board to take a decision on the proposed transaction. As per Rule 15.2, interested directors do not participate. If any directors is interested in any other contract or arrangement with a related party, such director shall not be present at the meeting during the discussions on the subject matter of the resolution related to the to such contract or arrangement. And as per Rule 15.3, transactions with the
He will
related...
not be participating. He is not asked to go out of the room, right?
Yeah, you see, there is a
No.
Atulbhai, there is a contradiction. There is a contradiction. The rule says that he shall not be present, and the act, so far as I recall, says that he should not be present. Okay, so to my mind, the point is that the act will prevail over the rule, and then he should not actually be present at the meeting at which the related party transaction is discussed, if he is interested. Now, there is another perspective I want to share, which is extremely important. I don't know how many of the professional members, agreed to subscribe to my view. There is a huge dichotomy where it comes to the Act and the LODR regulations, where it comes to approval of related party transactions. The Act says that the related party transactions will have to be approved by the audit committee. Okay. If you look at Regulation 23, it talks about related party transactions being approved
Only by
the independent directors who are part of the committee. So therefore, if your audit committee consists of non-independent directors, the question is that whether they should continue at the time when the matter is being discussed. Now, to my mind, the answer is actually they should not be participating, and they should therefore not be available at the time when the related party transaction is discussed, and they should come back to the meeting after the decision has been taken. Now, the other issue, which of course there is no answer in the law, is that, you see, what is the what is the function of an independent director? The function of an independent director is to give an independent judgment on matters concerning the company in a non-executive capacity, right? Now, if I am going to be asked to take a decision on a related party transaction where commercial aspects are involved, and I may not be aware of the commercial aspects, you see, and because I'm coming to the boardroom once in 3 months. So the question is that whether the law is correct in saying that an independent director should perform an executive function, such as approving a related party transaction, when he is actually a non-executive functionary. And this will give rise to, it is anathema to, it is the anathema to independence if an independent director is allowed to ask to participate in an executive function. And therefore, to my mind, the law needs to be reviewed, whether it should be the responsibility of the independent directors alone to decide on a related party transaction, because everything else is done by the audit committee. Okay, so this is something which, in fact, in a personal capacity, I've represented with SEBI, but there has been no response. I have also flagged it off in several seminars where senior people from the directors fraternity have been available. I have not got satisfactory answers, but then we are still living with the dichotomy in the law that whereas the Act says that it is the audit committee which has to approve, the LODR says that it has to be approved by the independent directors who are members of the audit committee. That's a contradiction which we are living with.
Anyway, over a period of time, it will get harmonized because in the past also there used to be disorganization. But only
So
thing
I
is,
don't think it's not been harmonized. I think SEBI has clear views on this. It has not been harmonized now for 3 years. So
yeah,
I
that
do
is
not
true.
know.
That is true. That is true.
So it is, yeah, it is actually the even independent director says many times that we are the people who are responsible for the related party transaction, and the transaction, the people who does transaction are not at all part.
Correct.
Many, yeah,
Exactly. Correct.
Yeah, you're right. There you are. You touched upon the point. That's it.
yeah, Nayan, go ahead.
Mind, it's already 1 o'clock, huh?
Yes, sir. So I'm taking it a little bit quick then. So the CSR is the another disclosure which a company has to made in the board report. So it is a self-regulated business model that helps a company be socially accountable to itself and its stakeholders and the public. So CSR applicability in India is there are some conditions which has to be fulfilled. So the company for the board report has to, shall include an annual report on the CSR activity, shall comprise the following. There should be the brief outline of the CSR policy, which is including the overview of the project and the program which is proposed to be undertaken, and refer to the web link to the CSR policy and the projects or the program. And there should be the composition of the CSR committee, number of meetings held during the year, average of net profit for the 3 immediate preceding years, prescribed CSR expenditure, that is 2% of the clause C above, which is mentioned, and detail of amount spent on CSR during the year, including the total amount to be spent, amount unspent, and manner in which the amount has been spent. In case the prescribed CSR amount has not been spent and the reasons for not spending the same, a responsibility statement from the CSR committee that the implementation and the monitoring of the CSR policy is in compliance with the CSR objectives of the company and the policies of the company. So the report shall disclose about the CSR policy of the company and the CSR initiative taken during the year. So where the said policy is available on the website of the company, it would be sufficient to disclose the silent features of such a policy or any change therein, and the web link at which the company complete policy is available. So in case the company is not having a website, such company should provide the details about the CSR policy developed and the implemented by the company on the CSR initiative taken during the year. And the conservation of energy technology. For this, the board shall cover the following information, like conservation of energy, like what are the steps taken or impact on the conservation of energy, the steps taken by the company for utilizing those alternate source of energy, the capital investment on the energy conservation equipment. In the case of technology absorption, the company shall make the information for the efforts which is made toward the technology absorption and the benefits derived, like product improvement, cost reduction, product development. So in case of imported technology, during the last 3 recon from the beginning of the financial year, the details of the technology imported, the years of import, if not fully absorbed, areas where the absorption has not taken place, and the reasons thereof, and the expenditure incurred on the research and development. For foreign exchange and earning ratio, the foreign exchange earned in terms of actual inflow during the year and the foreign exchange outgo during the year. In terms of the actual outflow, provided that the requirement of furnishing the information and details under this sub-rule shall not apply to the government company engaged in producing the defense equipment. So for the risk management, the element that will be the part of a board report is the various element of the risk which may threaten the existence of the company, and the strategy to mitigate such risk should be disclosed in the board report. And there should be the details of establishment of the vigil mechanism, and that the element which is required to be the part of the board report for the vigil mechanism should be the directors and employee to report their genuine concerns about the unethical behavior, adequate safeguards against the victimization, and direct access to the higher levels of the supervisors and the chairman of the committees. And there should be the material order of judicial bodies and regulators should be disclosed in the board report. Auditors, every company making its annual report shall make a disclosure in its annual report about the auditor of the company for the financial year. The details shall be disclosed in the following manner, like statutory auditor of the company, secretarial auditor of the company, if it is applicable, and applicability of the secretarial audit is already described under the law. So, and there are compliances with the secretarial standard, like these standards which is applicable to the companies are required to comply with the Companies Act, and that they should be secretarial standard on the meeting of the board, that is SS1. The board shall include that statement with they are complying with the applicable SS. So in order to certain portion of the applicable standard is not adhered, the same should be highlighted in the report along with the reason for not complying with the same. So the compliance with the secretarial standard voluntarily adopted by the company should also be instated in the report. And if is there any auditor's qualification, the report shall include that explanation or comment on every qualification, reservation, adverse remark, or disclaimer which is made in the auditor's report and the secretarial audit report. So if is there any no modification opinion, then the statement shall also indicate in that scenario. So if the company is in the CIR process, then it has been imitated against the company shall disclose such information in the annual report with such a relevant details of such CIR process, like who initiated the CIRP, interim resolution professional, default amount, and the last date of submission, committing of the creditors. So the failures to implementing any corporate action in case the company has not complied with the corporate action, that shall has to be reported in the board report. And for the annual report, that should include a statement which is regarding the filing of annual report with the ROC. The copy of annual report shall be placed on the website of the company, if any, and the web link of such annual report shall be disclosed on the report. So any other disclosures where statement or applicable with the consolidated financial statement is also being presented in addition to the standalone financials of the company, if is there, so that has to be made. If is there any key initiative with respect to the stakeholder relationship, customer relationship, environment, sustainability, health and safety. And there are disclosures which is pertaining to the sexual harassment of the women at the workplace, that is Prevention, Prohibition and Redressal Act 2013, and that has to cover with the statement that the company is in compliance with the provisions relating to the internal committee under the sexual harassment of the women at the workplace, and the detail of number of cases filed and disposed of under this POSH Act 2013. So there are few disclosures required to be made for the listing regulation, like statement of deviation or variation, management discussion and analysis report, and material development in human resources, detail of significant changes. There are some ratios which is to be key financial ratio, which is to be given with the explanation in the board report, and the certificate on compliance of the conditions of corporate governance, suspension of trading, if any. So these are the few disclosures which the company has to made recommended by the SS4 to be done. And there are some other requirements like approval of the report, signing of the report, and dissemination, like copies of the report to the members, placing the report on the website. So these are the other requirements which is given under the SS4 to be complied by the company. Filing and the submission of the report, and then few annexures which shall disclose the basic information and the disclosures of the company, like remuneration, secretarial audit report, annual report, and details of conservation. So these has to be made under the annexures only. So in conclusion, we can say that the secretarial standard issued by the ICSI, it plays a very important role in promoting the good governance practice in the companies, and by providing the uniform approach to the documentation and procedures which is followed by the company's activities, the standard help to enhance the transparency, accountability in the functioning of the companies. And it is therefore essential for company secretaries to familiarize themselves with secretarial standards and ensure that they are followed in letter and spirit in their organization. So though this standard has not been made mandatory yet, so this would be adhered by the companies in order to ensure the better disclosure, transparency And in practice, many organizations are referring to SS4 as well as the guidance note which is given by the ICSI. Thank you.
Yeah.
Yeah, so thanks, Nan. We can start the question, Mr. Bala.
Yes, yeah. A raid of the custom departments took place in the factory. The senior staff and the director's statement were recorded. A demand of 5 crores was actually raised on the company for and filed appeal against the commissioner level. The aspect is not mentioned in the direct reports. Moreover, statutory auditor also did not draw the attention of this aspect. It is a material financial liability. Should not the MD be pulled up and auditor also? Minority shareholders, what recourse they actually have? Minority shareholder who is also a director, he has not received any notice sent to him for the board meeting and shown attendance meeting or in case of the private limited company. Even minority director did not receive but signed minutes. The affairs are managed in totally non-compliant manner and in violation of the company law provision.
So it has to be disclosed, right? I mean, any abnormal raid or saying somewhere it has to be recorded.
So
Mr.
he
Mr.
says-
Kalidash,
He says it is not disclosed.
Mr.
Then he
Kalidas,
says-
you are muted. You are muted. You have to unmute. Yeah.
Simple.
Yeah.
You know, this is a serious event and it has to be disclosed. You know, whether the question is that whether the managing director needs to be pulled up for not facilitating disclosure, or the auditor needs to be pulled up for not disclosing. Of course, there is a aberration where it comes to the responsibilities. It should have been reported, particularly if it was of a significant nature. So in my view, see the sum and substance of a report. Let us understand the board's report, the purpose of a board's report. The purpose of a board's report is to ensure that all the shareholders get without any asymmetry where it comes to information sharing, all the shareholders get the same information on important aspects relating to the company's operations. So if you have missed out on disclosure where it comes to something material, which may not be pleasant to the board or pleasant to the company, nonetheless, it has to be disclosed. So whoever is responsible for not disclosing, you must mention, has to be held responsible. And if you have appealed, if you have simply made an appeal just for the sake of appeal, then the requirement is that you should also give to the shareholders a perspective as to the balance of justice available in the matter. What I am trying to say is that suppose you have filed an appeal, which has been in the past, there is precedence of such appeals being dismissed, then you should say that, or by all means you own up. And there is a requirement in the accounting standard of contingent liabilities to even assign a probability to such kind of an occurrence and book the liability to the extent it is plausible in the accounts. So there is no escaping disclosure of such information.
But since here it is not disclosed, actually, the possible action will be regulator will actually take up. As he rightly says, the company, the responsible directors will also be issued the notices, they will be actually heard. And equally, auditors also will be summoned upon that the things will be there. Ultimately, they'll have to pay the non-compliances, whatever is there. My question is with respect to the public wholly owned subsidiary. Whether the appointment of the independent director is applicable to wholly owned subsidiary companies, section 149(4), right with the rule 4. If the ID appointment is not applicable to wholly owned subsidiary, whether constitutes the audit committee and nomination remuneration committee is applicable to the WOS. If applicable, how the composition of the committee without IDs, section 177, 178, right with the rule 4. If ID appointment and committee constitution are not applicable, whether the evaluation of the performance of the board, individual director, and its committee applicable to wholly owned subsidiary. If it's applicable, how the evaluation will be done without IDs and the committees.
Here, you see, the law is clear that there are certain exceptions which are there in the Act where it comes to the composition of the board. One of the requirements is that the requirement of an audit committee and nomination committee would not apply to a wholly owned subsidiary. So therefore, the question would be whether, but then please do not forget that under Regulation 28, for the listed companies, if you are a material subsidiary, notwithstanding that it is a wholly owned subsidiary, there is a requirement on the part of the parent board to appoint one single independent director. So therefore, to my mind, let us accept one thing. It is not as if the appointment of an independent director has to be mandated by law. It is something which is a requirement for the protection of the shareholders and also for the directors. So my point is that let us walk the extra mile and not, relegate the law to merely a compliance exercise and adopt a strictly ticking the box approach. Please observe governance beyond the limits of law. That is my point. So even if you are a wholly owned subsidiary, if you are a material subsidiary, even if the law does not allow you to, does not necessitate that you should have an independent director, by all means, there is no restriction insofar as voluntary acceptance of the law. And I would say that for the sake of governance, we should ensure that an independent director is in place.
If the company does not have the website, whether attaching a MGT7 as on the date signing the board report shall be considered as a complaint with respect to mentioning of the web link in the annual report.
The website is a compulsory requirement for a listed company, so there is no choice in the matter. But where it comes to an unlisted company, there is a choice available. Now, the MGT7 is something which is actually now the law has been altered in comparison to the earlier law. Now you are supposed to give information as on the end of the financial year, notwithstanding that MGT7 is to be filed within 60 days from the date of the annual general meeting. So I see there is no problem where it comes to aggregating information which has to be put into the MGT7. You should, however, give a rider to the effect that the requirement to file MGT7 will arise upon adoption of the accounts and upon completion of the annual general meeting. But at the same time, you should share whatever information is to be disclosed in MGT7, provide a web link to enable the shareholders to access that information.
Board report does not have the paragraph, page number, etc.
What is come back, please? What is your question?
Board report does not have paragraphs, page number, etc.
That is, it shows it smacks of inefficiency. So, but that whether now board's report is, see, I have seen funny orders, adjudication orders of the ROC, where the ROC have pulled up the company for not numbering the minutes, etc. I have not come across any such situation where the board report has not been numbered or it has been. But it is, you see, the intention, the purpose of a report is to classify, is divided into paragraphs so that the shareholders are in a position to read. I don't see why there should be any problem. I mean, I don't think this is a question which is fit enough to be discussed in a forum such as this.
In fact, according to me, company secretary should have the excellent report writing skill. This sort of the thing should not actually be put up. And another thing is there, yes, as you rightly said, ROC has actually taken up the matter on the board report being not numbered. There have been penalization actions are there actually. Please take up the provision of the gifts to directors, members at the board meeting and AGM.
There is express provision in Secretarial Standard 2 against the provision of gifts, etc. So therefore, that applies equally to directors as also to shareholders. Of course, today we are in the third year of where you have virtual meetings. And I think from what I can see, the position is going to be after 1st of October is that we probably will have a system whereby we will continue to have virtual meetings. So the question of giving gifts to the shareholders for attending meetings will not probably be a problem anymore. But even if a company has a policy, there should not be no gift. I think the only thing that you can give at the very most, to my mind, is a discount coupon. But you cannot give a gift in any form. In fact, I know that this practice is rampant in cities like Delhi, where people expect gifts of the company, sweet boxes, etc. And as a matter of policy, it should be discouraged.
I think Jain Pandey has raised question.
1 minute. 1 minute. It is also question, I think, was also mentioning gift to the directors, right?
Yeah.
What is your view, Mr. Kalidas, on that?
No question. No question. You see, why should you give the directors any gifts? They are anyway being paid. Today, the law has been actually also flexed to provide that even if you are, if supposing the company is making losses, now there is a provision for even payment of remuneration to the non-executive directors as per Schedule 5. So when you are paying directors their sitting fees, and then you are paying them a remuneration for even in case of inadequacy of profit, I don't see any reason why there should be any provision of any gift at all. And most importantly, where it comes to independent directors, you have they get the immunization under Section 149(12). They are not responsible for any acts of omission or commission which is attributable to their neglect. So with this huge amount of cushion being available, I don't see any reason why independent directors, or for that matter, the directors, should be pampered through gifts.
Dipti, really speaking, there should not be any gift at all. Another thing is there, for the information of Jain Pandey, I would try to again say there is a clear-cut judgment given by the RD in a Madras Fertilizers case on this very same issue, where the Madras Fertilizers has distributed the gifts at the time of the annual general meeting, and it was actually criticized, and there is a severe action has been taken, and action initiated against only the company secretary, not by other people. You can go through the case. He listed out the various issues in that order. It was a very speaking order. I have come across an annual report of the listed company wherein the details of the employee exceeding the remuneration limits are not mentioned. Is it available on the inspection? Is it the right way of disclosure?
Normally, companies avoid attaching this list because it causes a lot of, heartburn, particularly amongst shareholders. I recall my one annual general meeting in ACC when one of the shareholders raised a question with the chairman, why are you having a costly company secretary like Kalidas? So now that is something which, it is the board's prerogative. So what companies do is that as opposed to attaching this information as part of the annual report, they provide a web link. And that would be, to my mind, appropriate compliance. You provide a web link by which the shareholder, whomsoever is interested, can access that information. So I think that would be a better way of doing it, as opposed to distributing it as part of the annual report.
Or in practical real-life situation, board of directors ensures compliance with Section 134 by having the oral assurance from the CFO, auditor, CS, or through some written communication.
Yeah, you see, 134, the board's responsibility statement is not something which has to be belittled. It has to be appreciated in the spirit in which the law has been enacted. So therefore, directors need to be very serious when they are signing this declaration. Now, how do they sign? Now, there are certain assurances that they look to. One is there is an internal audit function which flags off any concerns with regard to inadequacy in internal control. Then you've got whistleblower mechanism. Then you've got the functioning of the audit committee. In fact, in the better managed companies, every audit committee meeting of the board starts with an interaction between the independent directors and the auditors, where the auditors are allowed to raise any concerns which they have insofar as the management's interference is concerned over their independent functioning. So these are the assurances that the board can, sort of fall back on before issuing this responsibility statement. And let us be very honest, it is not as simple certification which is done merely to satisfy the requirements of law. The board should be very serious and understand whether they are signing after being aware that the company has ensured that the checks and balances are in place where it comes to ensuring that compliances in accounting, law, etc. are being ensured.
If management considers the company the going concern, how far the auditors has to go? I think the auditors have to apply their own mind based on the accounting standard and the criteria which has been actually given by the
I agree with you. I
Chartered
agree with you. The board, the auditors can at the most say that the management has represented that if they have any concerns, they can say that although the management has represented that they acknowledge the going concern status of the company, for these reasons, we have a reservation, we have a we are not very comfortable with this status, and they can state what are the reasons which are vitiating their view with regard to the going concern status of the company.
The ratio and the cash flow statements are part of the financial statement. Is it reference is required to be made in the director's report?
Yes, if you look at the definition of financial statement under the Act, that is, the financial statement has been defined to include not only the profit and loss account, balance sheet, but also the cash flow statement. So in case where the cash flow statement is a requirement under the law, then the accounts are not complete unless you have the cash flow. So you have to, the auditors have to refer in their report to the financial accounts and as also the cash flow statement. They are also certifying the cash flow statement.
Name lending in the audit profession was the standard. MGT7 is a risky report, but it is given.
See, let's not debate on things which are happening, and let's discuss the law as it stands. I'm opposed to discussing, what is the reality and all that. I think we have got enough space as professionals to operate in a professional manner. If somebody is underselling, if somebody is undercutting to get a fee, lending names, etc., all these are unethical practices, and I think these should not be discussed as a part
Absolutely, I agree with you. If somebody decides to do the unethical thing, we are not here because they have to be behaving ethical. That is what it is expected. We being a professional, we should behave ethically. Let us not talk. That's right. I agree with you. CS issuing the certificate based on the CA auditor's report. Then why not CA take the responsibility, CS sign without any check?
See, it is a settled principle here. Dipti, just let me say that the law says,
I was just drawing the attention. We have to let us speed up 1:27. That's all. Please go ahead.
Last question. I think this is the last question we should take for the day, because I think we've had a very long session and very, very incisive session. But I will take this question. You see, very often it has been raised in forum whether the company secretary is signing the the accounts, and whether he has any responsibility where it comes to certifying the fair and true view. Now it is a settled position. This was also mentioned in the MCA circular, which was issued under the Companies Act of 1956. When the company secretary is signing the accounts, he is only signing the accounts for the purposes of authenticating the signature of the other directors. So unless the board has made the company secretary responsible for the financial function and made him responsible as an officer in default under section 2 subsection 60, the company secretary has no responsibility on the fair and true nature of the accounts. He is simply signing the accounts to establish the authenticity of the other signatories. So I don't think there is any functional responsibility that can be assigned to a company secretary where it comes to, although I have seen the, you see, where it comes to adjudication powers, the authorities concerned are going overboard, and they are being very trigger happy. I have seen one adjudication order of the ROC where the ROC has fined the secretarial auditor for not pointing out the fair and true nature of the accounts. I don't think the secretarial auditor has no function, has any functional responsibility to certify the fair and true view of the accounts. So to my mind, I think we are going overboard, and let us be conscious of our own responsibilities, and that the responsibility is compliance with the laws that are impacting the company's business, right? Thank you.
Most of
Over to
Indian
you.
companies have a co-web of group companies and they trade among themselves. Cannot be, it is stopped.
I think, Mr. Balakrishnan, we should not encourage such questions. You see, law is on the one side, and there are practices galore which happen to circumvent the law. Are we here to discuss about matters by which you can circumvent the law? I don't think so. I think this does not merit a discussion, this question.
What statement can be provided when profit of the year has been transferred to the retained earnings and not to the general? So I think it to be discussed actually. She said actually what are the disclosures to do. Minority director asked to certain clarification from the managing director, but he declined to share the minutes of the board meeting and the AGM, EGM minutes and auditor management representation letter before adopting the statement. Even
I
photos
think
were.
this is not relevant to board's report, this query. Please
Okay.
keep this.
Yeah.
Okay.
In any
Project-
case, the independent director has a right to demand copies of the minutes of the meetings of the board committees of which he is a member, as also the minutes of the meetings of the general meetings where he has been a participant. Up to the date he is part of the board, he has a right to ask. So if the managing director is not complying with the requirement, then he is guilty of dereliction of duty.
Project getting delayed 4 5 years, that we think we discussed that. Regarding material disclosure, the penalty levied in terms of money, that also we talked about it. Project declared commercially commenced but not stabilized even for the next 2 years. No production from it, then whether it required disclosure as a material change affecting the financial. Yeah, anything affecting the financial stability of the company will have to be disclosed here. There is no dividend distribution tax, that is right. Only TDS we talked about it. The shareholder can reduce or cancel the dividend. Yeah, that is the information you are giving. Rating, you talked about it. No accounting standard for direct report, that is true. What about the mention of the ID on termination of the term disclosure?
So what is the question? ID, if there is a term, if you want to terminate, means are you talking about removal of an independent director? If you are talking about removal of an independent director, then the law provides under section 169 that the independent director shall be given a reasonable opportunity to represent his case, either by way of a written representation or by way of a verbal representation on the floor of the meeting. So you cannot take recourse to removal without giving an opportunity to the independent director or the director who is sought to be removed under 169.
In case the parent company is merged with another company without a change in the shareholding of the subsidiary company, is this required to be disclosed in the board report?
I don't know how the parent company can merge into the subsidiary company unless there is a resolution for the sale of the entire interest. I think it's not a question which has been properly framed.
How the change in the composition of the committee will be disclosed in case of the shareholders' approval is pending for the appointment of the independent director as on date of the board report, since they are additional director and subject to be appointed.
Yeah, you mentioned that they have been appointed as an additional director in the capacity of an independent director, and that their regularization process will happen at this AGM or at an extraordinary general meeting or whatever. You have to mention.
SS4 is not mandatory now. Any tentative date of mandatory of SS4, that all depends upon the government. We cannot say anything. Yeah.
Next. Yeah.
Do the minutes of the meeting of only independent directors, separate meeting is required to be placed before the board pursuant to part 2 of SEBI LODR. Minimum information to be placed before the board.
This I have a view on this. In fact, our secretarial standard 1 says that meeting of the independent directors is not a meeting of the committee. I have a personal view. The personal view is that you see, the independent directors meeting is a requirement mandated under Schedule 4. So to my mind, there is a legal requirement to have a meeting of the independent directors at least once in a year. And at least till the time I was part of ACC, we used to have every year not one meeting. We used to have at least 3 or 4 meetings of the independent directors, and invariably the minutes of the meeting would be shared. So to my mind, considering that there is a stated specific agenda which is to be transacted by the independent directors, I do not see why these should not be shared. Even if you don't want to share the minutes, the board should be made aware of the outcome of the independent directors meeting. This is my personal view. I mean, I said it's not reflecting the views of the institute or anybody, but by way of corporate governance, you should share the minutes of the independent directors meeting, or at least share the the quintessence of what transpired at the meeting.
For unlisted public company, whether disclosure should be gross remuneration or net remuneration to director and the top down employees remuneration.
It is based on the cost to company. So therefore, it cannot be ever net remuneration. You can say gross and then subject to tax at source. But to my mind, the intention is to gross up earnings.
Yeah, cost to the company. Index is applicable in India. It is suggested to take tables from IAS 28 and AS instead of IAS 28. Somebody has given this. One more important part of control is not more than with director percentage holding 50%. There's the information again. Whether receipts of director from group companies shall need to be disclosed with a reference to service charges received from associate company or related group companies.
See, when a director is holding any position in a group and is receiving remuneration in any capacity other than that of other than the services rendered by him as a director, under Section 188, it tantamounts to holding of office or place of profit. So you'll have to seek the approval of the board for such purposes, and of course the audit committee. And if it is beyond the threshold laid down under 188, you'll have to go to the shareholders.
Is it mandatory to hold the shares in a company in order to extend a deposit, say by an individual or a company? This question is for a private company.
There is no requirement under law for a director to hold shares in the company. Now, if you want to force the director to hold shares so that you are able to take deposits from him which are exempt deposits, by all means do that. But there is no compulsion for a director to hold shares.
That is done away with. A long time back, there was a qualification share, which is now done away with that. IT are simply not approving RPTs just because to avoid complications in future. What is the way out?
There is no way out. I think this is something which you have to address. It reflects on the independent director's lack of confidence in the board, and that should be addressed by the chairman and the internal management.
Request similar webinar. This is for Dipti to you.
Yeah.
Request similar webinar for CSR, EAG, and BRSR, etc. Okay. What are the type of provision forming CSR committee for the government? That is not the question here. Does a company continue to be covered under the CSR provision which ceases to fall under the purview of the provision of the immediately previous year? Now, that also we'll discuss on CSR. Forex outflow, is it required to be actual outflow or it should be mercantile accrual basis? If any exposure is booked and reflected in the P&L account and balance sheet, I think it should be actually mentioned.
It is accrual. It's accrual accounting because you are adopting accrual as the basis of accounting, except for CSR spends, which are on actual. So it should be, even if it is accounted for on mercantile basis, it should be recorded.
Mr. Bala, I think we should stop now. 140 almost it is.
Okay.
And I hardly 1 or 2 questions. All the question raised earlier is answered. Now little bit said. Because some 2-3 questions only left, we will reply them individually. We'll connect.
Sure.
Okay.
Sure.
I think Mr. Kalidas, it's okay, no? Because it's almost 140 now.
Fine. Yeah, in fact, my wife's calling me to lunch.
Okay, friends. Thanks a lot, Mr. Kalidas. Everyone is praising you in the chat
No,
box
no, no,
and
no.
for wonderful session. Thanks a lot for your sharing knowledge,
My pleasure, my
experience.
pleasure. See,
Thank you
knowledge
very
is
much.
knowledge is something to be shared. I have not shared knowledge. I've shared only experience. Okay. Thanks very much for giving me an opportunity to be a participant in this. Best wishes.
It was really
Thank you.
It was really a very enlightening session because we can see the time itself. We can see the number of people present even at this time. 9 is made a wonderful presentation covering all the aspects of not leaving anything for the choice. Very good job you have done, 9. Thanks a lot to Mr. Kalidas for your sharing the experiences. I think with this we close the session. We meet yet another session on next one. Thank you.
Yeah.
Thank you.
Thank you.
Bye-bye.
Thank you. Thank you, Nan.
Wish you a good weekend.
Thanks.
Thank you.
Bye-bye.